Well, welcome to this episode of Market Shares. I'm your host, Tony Blodgett. And today we're just going to do a little recap of 2022 and really more than that, some kind of predictions, some things that I see being a theme in the mortgage industry as we move into 2023. You know, the first thing that comes to mind as I think about 2022 is the saying, in like a lion, out like a lamb. You see, I was born in March, and that's the key phrase they say for March, right? The beginning of spring, where the weather is really aggressive, and then towards the end of the month, you know, things calm down. And that's kind of how I feel about the mortgage industry as we came roaring in to 2022, still riding that wave that really started around March of 2020. And it wasn't until about February when we really started realizing that 2022 was going to be a very different year in the mortgage space. And I mean, interest rates were still in the low threes as we entered the year. And I think there was some predictions that they would go up modestly, but I don't think at that time anyone really thought that interest rates would get up into the mid sevens, which is what we saw here before rates started coming back down as we got towards the end of 2022. So it was just a very transitional year, and it was, I think, a wake-up call for a lot of us. And, you know, a lot of people like to talk about how great 2020 and 2021 were, but I think what they forget to realize is that it's really March of 2020 through, say, March of 2022. That was the 2 years, the two unicorn years, if you will. So even if you look at your performance in 2022, my guess is it was still propped up a bit by the first couple months of the year. And I don't think we're going to see that in 2023. So, you know, look, I think that those of us that are in this industry long-term, whether it be mortgage or real estate, we're not going anywhere. It's just a year that we're going to have to adapt. And 2022 was like the cold shower. It kind of snapped us out of, the gravy train that we had been on. Not that it was all easy the last couple of years, don't get me wrong, but what was easy was finding new clients, right? That was the easy part. I mean, we had lots of other challenges, but finding a new client to help purchase or refinance their home was not one of them for most of us, and that has changed significantly. So hopefully you've been able to make those changes. We're going to continue on this show to give you ideas and strategies. We're going to do more of that as we move in to next year. I have a conversation coming up about the best way to build retention with your client. We're going to talk about hosting, first-time homebuyer classes and lunch and learns and some different tactical stuff that you could put into your business, because I think we all need that. But we need to shift from this mindset of consuming content to actually learning things that we can put into action immediately in our business so that we can see results. And that, I think, is going to be a theme in 2023, is less, aggregation of ideas and more implementing those ideas that you've learned. You're going to have to hold yourself to a level of accountability. All of us will have to hold ourselves to a level of accountability to execute on the things that we know need to be done, not just accumulate a lot of great ideas. So if you don't mind, I'm going to shift into some of the, I don't want to say predictions, but just, I think, some of the things that are going to be present in the market in 2023. First off, I'm going to start with interest rates, because although I'm glad I was correct in predicting rates wouldn't go to 9, still don't think that's going to happen. But you know what? I don't think they're going to go down as much as we all are hoping that they would. I think inflation is going to continue to be a bit persistent, and we're going to continue to see very low unemployment numbers and strong wage inflation that I just think is going to create this longer term inflation in our market. Now, it doesn't mean it's going to be super high inflation like what we've seen, but I don't think it's going to get to the Fed's target rate of 2% as quickly as everyone is hoping. And so as a result, I think the Feds are going to have to continue with their aggressive monetary policy. I don't think they raise rates a whole lot more. I think we've already established that 5%, rates probably where the Fed stops. But I just don't think they're as quick to turn around as many people think, because inflation will continue, I think, to be part of our part of our economy, part of our market. We're going to have to learn to live with a little bit higher inflation. And there's some things we can do about that, which are a conversation for a whole nother topic about what to do in a higher inflation market. But what it does mean is that rates probably don't get back down into the 4s or 3s, maybe high 4s. Maybe we dip there. I expect to see rates in the 5s to low 6s throughout the 2023. And look, I would love to be wrong. I'm in the mortgage business, so lower interest rates would be great. I would not plan on that if I were you. I would say that would be a gift if something happens in our market that has rates for some reason get back into the 3s. It could happen. We didn't see COVID coming either, did we? But here we are. So rates remain high in 2023. Not as high as they've been, but definitely not as low as we'd like them to be. Margins stay compressed. Margins are really compressed right now. And depending on where you're at in the mortgage space, you may or may not feel it. I mean, chances are you do feel it. If you're a loan officer and you're on the street, you find that you're competing for every deal. It doesn't matter if you work for a bank, if you're a broker, if you're a mortgage banker. Everyone is discounting rates. Everyone is jockeying with price in order to get market share. And it's creating significant price compression. We feel it all the way through the mortgage industry. It starts obviously at point of sale and the challenges you have there, but it works its way through the economics of your team. If you're a team originator, it works through the economics of your branch, your region, and of course, every mortgage company out there. Most of the public companies, as you've seen, are losing millions and millions of dollars. You can assume there's similar things on a smaller scale going on all across the mortgage industry. And I don't think that changes overnight. And so we have to learn to adapt and work within a tighter margin environment. And what does that mean? Well, maybe we'll do some shows on some strategies to deal with that, but just know margins stay compressed in 2023, in my opinion. Sales matters more than ever, meaning salesmanship. You can't be an order taker anymore. You have to be great at building relationships, showing your clients how you bring value, showing your realtors, if you're a loan officer, how you bring value to the relationship. You have to be a salesperson, putting your name out there, putting your brand out there, doing marketing. That's not going to be enough. It's important. You need to do that stuff, but you also need to get your sales skills up. And we'll talk more about that as the year goes on, but just know salesmanship matters more than ever. It's a numbers game, so more calls. We've been talking about this on this show for months now. We've had Dan Keller on here talking about the number of calls that he's making right now. But you gotta make more calls in 2023. Many of you are successfully navigating this market today. It's probably because you're making more sales calls than you did in the last couple of years. That's not going to end in 2023. Relationships are more important than ever. And I mean relationships with your realtors. Let's start there, right? You should be talking to your realtors about their business plans, working together as a friendship, as partners on what they're doing in their business. What ideas do you have? Vice versa. You have to have deeper relationships. Just handing out a flyer with your rates or your products or your programs or your 2-1 buy down strategy, it's not going to be enough. You need to build deeper relationships. You need to build deeper relationships with your coworkers, with the people that you work with. You need to build deeper relationships with your clients and go deeper with each one of your clients. You need to learn what's important to them so that as you work through the mortgage process with them, the buying process, that you're going to be stickier. It's going to help them see value in the relationship, not just the commodity of the interest rate that you're offering them. And of course, you need to have a relationship with your past clients, with your database. There's going to be less opportunities to find refinances, but there will be opportunities, and you need to be their friend. You need to be the person who knows what's going on in their life and feel comfortable reaching out to them and checking checking in on how things are going with their mortgage, with their household needs, etc. That's going to be more important than ever. So relationships, more important than ever. Finding people when they need you. Okay, this is going to be a big theme in 2023, and you're already seeing this, right? With the likes of Sales Boomerang out there, and there's a number of other companies also that are trying to aggregate as much data as possible and then push it out to the mortgage professional and say, look, even though interest rates may not be low enough for your client to refinance because of interest rate, there may be something else significant going on in their life right now, and they need your help. Maybe they're moving. Maybe there's a divorce. Maybe their family size has grown. Maybe they have a kid going to college. All of these things, you can't just find them easily, but with the aggregation of multiple sources of data, you can predict what might be happening in a client's life. Some things are very obvious, right? Credit triggers, things of that nature. We can see those. Those are like table stakes at this point. You should know what's going on with your client's mortgage, but there's more than that. And I think it's just the beginning. I think you're going to see a real, push towards the ability to aggregate as much data as possible. Some companies will do it in-house. Some will use third-party services, but getting in front of a client when they need you. It's no different than what was talked about years ago in Simon Sinek's book or other books about what Target does or what other retail stores do, where they know your purchasing behavior and they know exactly what's going on. They know that you're going to have a baby before you, or maybe your family doesn't know yet, but Target knows because of your purchasing behavior, right? So they can see these things. Well, some more of that is going to be in the mortgage space, and you're going to want to be a loan officer who has access to that sort of data so that you can be the person in front of your client, because if it's not you, someone else is buying that data and they're going to figure it out. So finding your clients when they need you, not them reaching out to you, you reaching out to them, but you also have to have a relationship with them for that to work. Next, home values. I think they stay pretty flat. We've talked about a lot of analogies about what's going on with home values. We talk about the mountain and maybe the top blew off and they're still high, but the peak is gone or whatever. However you want to look at it. Look, home values are down a bit in most places across the country. Yes, I do believe we've really just lost the significant appreciation we saw in 2021. Most of that in most markets is probably gone, but we haven't taken a huge step back, and I don't suspect that we will. I think, you're going to look at the numbers for 2022, and you're going to see that we had modest appreciation when you're looking at the whole year, because things were still pretty hot at the beginning of the year. Probably 3%. I think it's somewhere in that neighborhood. Next year, NAR is projecting about 1.5% drop, I think, in home values. Okay, some markets will be more, some will be less. It'll be relatively flat, and there's going to continue to be low inventory. Look, this low inventory thing, I'm telling you, it's not going to fix itself anytime soon. With builders building less homes, so many people that are in their houses right now that have interest rates that they would never walk away from, that's going to have a lot of people stay in their homes longer. So I don't expect the inventory issues to solve anytime soon. And that's good for home values. Makes it difficult if you're looking to buy a new home. But inventories will be up, but nowhere close to what we would consider high levels. We'll have tight inventory, and home values stay pretty flat, I think, as we move through 2023. So what that means is when you're talking to a client about the value of home ownership, maybe there's less talk about the appreciation. There's less talk about the investment aspect of owning a home and more about the other values of owning a home. And believe me, there are plenty. I'm not going to get into that in this episode, but making sure that when you're talking to your client about why is now the right time to purchase, that you're highlighting the reasons to own a home that aren't just built around appreciation of the home. Getting down to the end of the list here. What else do I think is going to be a trend? I think you'll continue to see seller concessions be part of the negotiation process in 2023, okay? That means that as a mortgage professional, you have to be very well versed in what is the best way for an individual buyer to leverage the potential price reduction or incentive that they may get from the seller? Is it to pay for a temporary buy down? Is it to do a permanent buy down? Is it to simply take a reduction in the price or pay for their closing costs? You need to be equipped and prepared to not only understand how to leverage that money, but give advice on what's the best way to leverage a concession from a seller, so that you can talk to the agent and you can give them the advice, talk to the buyer, give them great advice, and make yourself a valuable part of the process, because otherwise they can just go get their rate anywhere. So how do you create value? We're constantly saying, how do I create more value as a loan originator? Well, I'll tell you, knowing strategies based on the individual circumstances, the goals, both short and long term, of your client, and advising them on how to use 3 to 5% concession from the seller in the very best way, specifically catered to them and displayed to them in a way that shows them the value, that is going to be a way to create value. And the best loan officers are going to be doing that. And that will be present in our market through 2023. Keeping the deal together. This is something that I feel like when I was originating was part of my job. And I think that this has gone away in the last couple of years. But being an advocate for helping the transaction stay together. That means helping the borrower, just get off the fence and feel like now is the right time to purchase a home. We talked about that briefly. But then once they have written the contract, how do we keep them in contract, right? I mean, look, let's be honest, buyers get buyer's remorse. There's a reason that there's a thing called buyer's remorse. It's because it's a natural thing that happens. How can you be an advocate and help your client not only be prepared for this feeling that they're more than likely going to have at least once and maybe multiple times during the process where they're going to get cold feet, and you're going to help them work through that? That's creating value in that relationship, helping them continue to, justify the decision that they had previously made to purchase this home, but also making sure that the team that partners with you, the real estate agent and other people involved in the transaction, you're all working together to help these transactions stay together. And there's some specific things that you can do to help make that happen. And you need to be an expert at recognizing when a borrower is getting cold feet and being part of the solution to help keep that transaction together. That's a huge opportunity for you to build value between you and your partners in 2023. I think that non-QM and creative loan options are going to continue to be really important. It obviously varies on what part of the country you're in. Certain parts of the country are more prone to employment type situations that are unique and different, where you need bank statement loans or other alternative non-QM products. And I think you'll continue to see some good product development happening as we've seen in the last half of 2022. We're seeing a lot of product development right now. So make sure as new programs, new products come out, that you're on top of it. You want to be in every training that your company provides. If there's something new and unique and different out there, you want to be the person who is the expert at that product, because it's going to help you forge that one new relationship that maybe otherwise you wouldn't have had. So non-QM, creative financing, more important than ever. And then the last one I'm going to touch on is renovation and reverse mortgages. These are not really intertwined, but I think both are really relevant. Renovation loans, look, when there's less inventory out there, people have a lot of equity in their homes. Yes, they got a great interest rate. No one wants to refinance necessarily. But when there is less options to go upgrade somewhere else and you have a ton of equity, leveraging some of that equity to do renovations and improvements to your existing home is the most natural thing to do. And it also exacerbates the problem of not enough inventory, but you're going to see a lot of people wanting to continue to make home improvements with the equity they have to their existing home. And then reverse mortgages. Look, this economy is going to be difficult, I think. It's very possible we enter into a stagflation type of an environment where we have a down economy. We continue to see inflation be a bit stubborn, not as high as it is, but stubborn. And we have a lot of our older generation, a lot of our baby boomers who, they're staying in their homes longer than ever. After the big run-up we've had, they now have a ton of equity in those homes, but the economy is very difficult. And, it potentially could be really difficult, I guess is what I'm getting at. And so a reverse mortgage to help, put them in a position to be able to afford the day-to-day things that you need to live. As inflation goes up, I promise you, Social Security won't keep up with it. And so as a result, you're going to find that people are going to have a more difficult time making ends meet. And if you have a home and you're over 62 and you have some equity, a reverse mortgage just might be the solution to help bridge that gap. So those are the things that, I kind of see as our trends, as the areas of focus for 2023. If any of those things that I mentioned, I'm sure lots of them you would agree with me. Other ones you go, I didn't think about that. I need to maybe be more prepared for that situation. So hopefully this list spurred some ideas in you. I got to tell you, we started this podcast. We started Market Shares in 2022, and it's been a great pleasure for me to come in here every single week and share some information with you guys, introduce you to a lot of people, and I'm really excited about what we're going to do in 2023 with the Market Shares podcast. So please subscribe, but more than that, just tell your friends in the mortgage business about it. Say, hey, have you seen this show? You should check it out. I would appreciate the recommendation, the endorsement, and we'll continue to try to bring, things from market updates to strategies and ideas, and maybe even some interviews with some of the top influencers in the mortgage space as we move through 2023. So you guys, thank you for your time and attention as always, and I hope you enjoyed this list. And Happy New Year, and let's make 2023 the best year yet. We're never going to repeat the last 2 years that we had, but through strategic innovation, hard work, and perseverance, you get to make your own market. And in 2023, each of us have the opportunity to make it our best year ever. With that, Happy New Year, and we'll see you next year.